Welcome to the 301 Club. My name is Chase,
My name is John.
and we are homeowners at age 25.
Yep.
So, what we're here to talk to you about is we're going to give you the one-on-one on owning real estate in your mid-20s, presented by the 301 Club.
Like and subscribe.
Yes. So, first, we wanted to give a background on how we decided to come to the conclusion that we wanted to buy a house. As you all know, it is 2022. Interest rates have gone off the charts, and we were not sure if we wanted to spend our money in a renting an apartment or buying a house.
Yeah. So I think we were renting over in Gaithersburg, over downtown Crown area, and we figured all the amount of money we're like kind of investing in living in an apartment and paying rent could probably be invested in something else. So we figured we'd get into the real estate game, and we ended up making that decision to get a house, which I think was a great idea.
Yeah, pretty much what it comes down to is, do you want to spend your money on liabilities or assets, right? And an apartment is a liability. We'll tell you that straight up. So we were throwing away probably $2,000 a month combined on the apartment. Another thing about it is landlords, they're going to make your life a living hell. And so instead of having a landlord and giving away your money, we decided to become our own landlord and use our money in a nest egg, which is this house we are sitting in right now.
Yeah, exactly. I think it's a great idea, and there was definitely a few steps along that journey from like, well, I guess living in an apartment and then making that move to buying a house. I think it was like maybe a few months, but when it comes down to it, I think it took us like a month or so to close. So that was also like a process, and I think that's what we're here to do today, is kind of go over what me and you did and the steps we took to get to that point. I mean, I guess first, if you want to start off, like, I guess the first tidbit of information.
Yeah, so
background.
Yeah, we can start off with the fact that we are first-time home buyers, both of us. That's definitely a piece of information that you want to take to the bank, especially when you go for your pre-approval, which will be our first topic, shopping for a budget. And here's the thing. The first mistake we made is we thought we could afford a $500,000 house because we are in the Montgomery County area, and that is pretty much the mean price of a house here. You're either going to get that or higher. So, and the reasons for that are the location of this area. We have really good crime rates. We have super good amenities and stores and businesses in the area, big box businesses, small businesses. That's really going to affect the price of the house. First off, we were looking for a place actually in Florida, or I was.
Yeah.
And that kind of brought me to realize that it might make more sense to have a partner just to continue to do the house hunting process.
Yeah, I think it was kind of like just the idea that it would be something that would move along quicker working with a partner, and I think me and you kind of came to that consensus that it would be better just to work with somebody that was like on the same sort of like, yeah, we're trying to do the same thing when it comes to real estate. So yeah, that was definitely the move that we made eventually after Florida.
Yeah, so one of the most important things about it being 2022, early 2022, was that it was totally a seller's market. So John and I had the smart idea to try to move faster than everyone else, than our competition, because especially the Fed had just increased interest rates 0.75, and this is in June, right?
Yeah, back in June.
So we started our process in the beginning of June, and the interest rate hike happened after our pre-approval process. So what we're going to jump into right now is our experience getting a pre-approval. We'll define what a pre-approval is, and we will also talk to you about the different attributes that can contribute to your pre-approval letter.
And types of loans.
Yeah, the type of loans we'll touch on. We'll start with a preview of that.
And
because
then,
that was something that we didn't really know going in there. The difference between a conventional and an FHA.
yeah,
There's a general consensus out there that you need 3.5%, which is with an FHA loan. However, there's some hidden fees on top of that, which include your PMI upfront, and also there's some restrictions and constraints on an FHA loan. So we actually only had to put 3% down with a conventional. And so John can start with how we got to find our first bank.
yeah. So I had, I believe we both had an account with PNC, and so we figured, we'd find time to go in, and we knew nothing about it. Like, just to reiterate that, like, even for the loans and all the details that go in between, we just weren't too sure on how to go about the process. So we ended up going to PNC, walking in, talked to a banker there that was willing to help us out and was willing to answer questions that we had about the process. And so, yeah, she kind of guided us through the whole thing. Kind of got us in contact with a loan officer. So that's what we ended up doing. And she gave us that, like, a little bit of tidbit information. I know you probably remember a little better than I do, but she mentioned how it would probably be better to rent it, buy a place, sit on it, and rent it out instead of trying to buy a place to flip it. So that kind of gave us a little bit of direction on what to do, because we were thinking about flipping. So if you want to go into, like, kind of what she said and how she, like, gave us that information.
Yeah. So it starts from the fact that I went to actually a real estate conference in Idaho, who was hosted by Lee Arnold, who's a real estate guru. And it's funny, he actually mentioned that renting is one of the last things you want to do in order to become a millionaire, because that's our goal, is to be millionaires. That's why we're starting this real estate journey and sharing this information, because we think anyone in their mid-20s these days can become a millionaire, contrary to what the news is saying about millennials not buying houses. So Lee Arnold says, buy a foreclosed house and flip it and make a profit. However, the downside of that is that you need a large capital investment up front. We didn't have that. So that goes into kind of how we defined our budget at this point now. So the first thing you have to understand is what your DTI is in a general level. You don't have to get too specific when you first visit the bank, but after we talked to Betty, we realized that was a very important piece of the puzzle. So, but the last thing to touch on meeting the banker is that she gave us information that was opposite to what we had heard before, and that's going to happen a lot in this journey. We discovered there's going to be a lot of professionals that you come across and a lot of very high up people, and you have to go in there with confidence, and you have to go in there with your intentions. And so that's where we ended up lowering our budget, because we realized after what the banker said, we could actually get 2 houses. And this is a process called seasoning. And Betty told us a story about her situation with her daughter. And John, do you remember the story? Maybe you can.
I know that it had something to do with the fact that, like, someone had already gotten a loan.
Yeah. So the main point is you can buy a house as an investor or as a residential owner. And if you're going to go the residential route, you got to only say certain things to the bank. For example, the story that Betty told us was that her daughter bought her first house, her first residential property, but then the fact that she had a kid coming and that her family was expanding, that gives the bank notice that maybe you need a bigger property. And a misconception is that you might have to sell your house,
right? Exactly.
To get to the next house. But what the advice that she gave us, which is what we ran with and what we are doing, we are living today, is buy a house, rent it out, and then buy another house. And it's extremely possible, especially with a partner.
I think that was, like, the main point, which was, that you don't have to necessarily sell your house to get another property, and if you have money saved up, you can just, invest in another property and have multiple. And I think that was a great tidbit of information, especially having property here in this area. It's just sitting on it over time, eventually, with the, with the market that I'm sure you can get into it.
It's an appreciating market.
Yeah, exactly. So
in this area, for
right,
sure.
Right. So yeah, I would say that that's kind of the main bit of information that we got from her. So we figured we'd take that route instead of going the route of flipping houses. Yeah.
Yeah. So yeah, basically we started with wanting to buy a $500,000 house because we wanted a single family detached home.
Right.
But that you're only going to get that for $500,000 in this
Minimum,
area.
yep.
So minimum, right? So we kind of changed our budget.
And I was talking with Preston. We were talking to Preston about a few things, and that's who we got in contact with after the banker referenced it. She had, because they don't have loan officers there sitting there on payroll, so they get us in contact with one of the loan officers for us to start moving forward. And I'm sure you can get into it because you kind of were the main source of contact between the loan officer. And then, like you were saying, they gave us that reality that it wouldn't be ideal to get that, that big of a loan versus getting like a $300,000 loan.
The purchase price of the property, you're going to expect to do 2 to 3% of that in closing costs, which is something that we didn't know going in. So that, again, we started with a $500,000 budget, but because of the closing costs piece of the equation, we ended up only with a $300,000 budget max. No more, no less. And again, we knew that from getting into our DTI, debt to income ratio.
Yeah. How much we have on hand to invest as well. Just knowing how much you have versus how much is needed, pretty much.
Exactly, because the fact is that buying a house is based on your income and not your assets or your money down. However, you do need a certain amount of money down, which we will get into. There's different ways to do that, especially in this day and age.
And I think like you were saying, to go back on the DTI, is you have to also have a certain amount of debt to income, because you can't have like several car loans or a hefty car loan and then also try to get a house on the same sort of like because you have a credit score and that gets affected. So there's a lot of things that go into it, and I think understanding how much debts you have versus how much income you're making, how much you have left over after you've paid off your bills and all your debts, your expenses, your phone bill, your car insurance, your car note, whatever it is. I think understanding all that and then realizing that, at the end of the day, you may have started out with like $2,000 a month, but your bills and all your expenses add up to be about $1,000. So you only realistically have $1,000 to put down towards mortgage every month. So I think that's what it comes down to, is just understanding that debt to income ratio.
Yeah, especially being realistic with your own debt to income ratio.
Yeah.
Because something we did, which we'll show you guys on the screen now, is we did a spreadsheet. We created our own, which lists all of our debts. And I feel like this might be most cases for those watching and in general of millennials, is that we had pretty high student loan debt, which was kind of one of the biggest kickers as to why we couldn't afford a $500,000 loan. Because of that increased our debt to income ratio too high.
Yeah, that was definitely a main factor, I think. Definitely.
Yeah. So we'll get into more details on the sheet that we're showing you in a later episode. But today we just want to highlight specifically, get a mindset of what your total payment might be. This is going to require you to do some research. It's public records are available to find the insurance and the taxes for your state and for your county and your city. It might be that deep. Some places they don't require county taxes, but ours does. Shout out to the 20886. And the other thing is your note rate. So that's going to be highlighted right here.
Right. And I believe a lot of this information came from our pre-approval or my.
Yeah. It was a lot of this you get from your pre-approval, but best practice is to prepare this document before you start going through pre-approval. What I will say is we moved a little bit faster than the average person maybe should have. It took us 1 month to go from pre-approval to close. Right. Which again we were trying to be competitive with the seller's market.
Right. That makes sense. And I believe you got this calculator off of a website, or I believe it was off of something. So I believe like there's stuff out there that definitely will help, and then they'll also see this and kind of get an idea of how it works. But I'm sure you can share it, or they can find somewhere online where they can just pull that off of the website, download it run their numbers, debt to income, what their debts are compared to how much their income is. I mean, it's pretty simple too. You can do the math in your head, I'm sure, but I think this includes like the taxes and all the PMI and all that, and how much you'd end up paying a monthly, depending on how much the principal is and all the taxes, the PMI included. You kind of get an estimate of how much you'd have to pay out, how much your debts are, and then hopefully your income is more than that. So realistically, I think they told us we had to have a percentage of, once you calculate it, I'm sure for everyone that's watching, they'll have that opportunity to realize that for certain loans you need, I think in general it's got to be under 45%, 49%.
Yeah, so for FHA you have to have 45% or less these days.
Right.
And for a Fannie Mae, Freddie Mac back loan, it's 50%.
Right.
Specific Freddie Mac, Fannie Mae loans, which we'll talk about later. But just having a general idea. This spreadsheet doesn't give you the calculations that the lender takes into account. For example, your debt. A misconception might be that your entire debt is calculated towards your debt to income ratio, which is your debts divided by how much you make. However, it's only the monthly payment being made towards your debt, because the bank wants to make sure that you can afford
the monthly
like we
payments,
said, the
minimum
note rate, the
right.
insurance, the taxes, and at the end of the day. So, yeah, that's something that we'll dive into a little bit deeper in a different episode. But this is what we had an idea of before we talked to the loan officer, which is the next step we had, right?
Right.
So we're talking to the first loan officer.
Do you want to get into seasoning? Is that kind of what Betty was going over?
Yeah.
Told us?
So that definitely relates to how we changed our strategy, because we started with wanting to flip. That was kind of my idea, my mindset. Right. I know you had the renting mindset.
Right.
And so that's when Betty mentioned that you can season.
Which I think
after about a year. So.
Right.
And this is unofficial. We don't know for sure, but depending on the bank that you talk to, it could be 6 months to a year. That's all the amount of time you need to stay as a residential owner, and then you can say, hey, I'm getting a dog, or I'm getting a family,
exactly.
or I'm getting married. Let me buy another house.
So this is a good idea for couples that want to work together and get a bigger house after they've I guess that goes into kind of realizing what money you're working with. Maybe it is a better idea to get a smaller townhouse at first, invest into that, and then a year later, 6 months for seasoning, whatever it may be, hey, you know what, go to the bank, be like, listen, I want something bigger, we can afford to, or we have someone leasing out this our place, we don't want to sell it, so we're just having people rent it, we have the money to invest and also pay for that mortgage for the next house, which might be a little bigger. So I think essentially, because the banks don't want investors to come in and buy all the property up and get good rates that normally would only go to for homeowners, people that are really not into the investment side. But there's just things that you can do to it's kind of a little, I guess it was you could say a backdoor finesse as I've heard before. And it's kind of just, if you're a couple, what goes hand in hand, don't sell your house. Just, if you get a house, save up money, get another one, rent out that spot, in any case, you don't necessarily need to sell your house essentially. And you can be working with someone, so yeah, I think that's what it comes down to, is just understanding that you can work with somebody else, or just do it yourself if you even want to. You could do it yourself too if you're making the right kind of money. You don't necessarily need to work with somebody, but when it comes down to just having that idea that you want to start small, move into bigger, and the bank will give you that opportunity to be like, okay, that makes sense. You're doing this for personal reasons. You were living in this place. Now you want to live in a bigger house. They'll give you a good rate, good house. But that's really it.